But let's invite the first corporate on our show now, Cigniti Technologies. The stock is up 52% in the last 1 year. It's also hit a fresh 52-week high with the up move that we're seeing. Came out with numbers a couple of weeks back, and it's been a strong Q3 performance. And the management has said that we're confident about maintaining our targets for FY23. Krishnan Venkatachari, the CFO at Cigniti Technologies, is with us on the show now. Afternoon, and thanks so much for joining in. Could you give us an indication of how Q4 has panned out? Because in Q3 and in the conference call which took place, you did indicate that you won some logos in Q3, which will start contributing to growth in the current quarter. So how has Q4 shaped up in terms of demand, in terms of revenue numbers, and what can you end the year with?
Good afternoon, and thanks for the opportunity. And yeah, Q4, as of now, we are cautiously optimistic, and definitely the business is looking good. I think going by the run rate, though we are not in the process of giving any guidance, but I think going by the run rate as to what you could see over the last 3 quarters, I think we are confident of repeating the performance for the quarter ahead. And the year ahead for the next year also looks very good based on the order book position and the kind of renewals which has taken place over the period. So we are confident to repeat the performance to a reasonable level. Absolutely.
Okay, what do you mean by reasonable level? Because 9-month revenues is $154 million, FY22 at $168 million, which, if going by the quarterly run rate, you would be doing a 25% growth this year itself. Can you tell us how much of it will be led by price increases? Because some of your clients have agreed to price hikes. Will you be able to take any more? Are there any negotiations ongoing right now?
Yeah, out of the 32 clients, out of the top 60 clients have given a price increase, and out of the range of price increase has moved from 7 to 10%. And this increase, which has been accounted for probably from 12 clients effective January, and the rest of the clients are getting affected from 1st of April. So that is to give the statistics, because based on the renewal timing and periodicity at which the negotiations have taken place. And going further in terms of the price increase for the existing clients, I think the existing set of clients probably in terms of the price increase, I would say that the scope or the headroom in terms of the revision on the price increase is very limited. But I think it's more to do with respect to the selling, because as a combination, just wanted to step back and give a breakup in terms of the digital engineering foray, which we have done very clearly. While the digital engineering per se in the segment in the last financial year was at about close to 6-7 million, I think this year it is contributing about 18%, 9%, which is at roughly about 18 million on the estimated number of 200 million plus. So we are giving a big push for the digital engineering, and we have estimated that we should be doing close to about 24% or so in the next year in terms of the total revenue, which could also be in the high teen growth, which we are confident of doing a high teen growth in the next year.
Could you repeat how much will digital engineering contribute to revenues in FY23? Next year, it will be 24%.
Next year, 24%. This year, we'll be closing with about 9% on the digital engineering side of the total, which yields me slightly. So I have now taken I've put in all my efforts in terms of trying to get through a better realization and better utilization on the digital engineering foray, which should tilt the margins in our favor.
Okay, what does that mean exactly? I was going to ask you about margins itself. Margins in your favor, you're looking at higher utilization, price hikes as well. Your margins have increased from 9.2% in Q1 of FY22 to levels of 15% in Q3 FY23. Is there more scope for improvement here? And if yes, by how much?
Absolutely. I think we are targeting north of 16% plus in the next year, based on the current estimates what we have. While the year probably could land up on an average, including all the quarters put together, could be at about 14.3%. But I think we will move up the north of 16% in a good way, basically based on this digital engineering foray with a price increase coming for the full year coming in, and then few composition mix in terms of offshore to on-site as we see more traction for offshore, which can yield us on the margin front. So these are the, and plus a pyramid mix, which is a continuing factor, and with the stable labor coming through over there, I think we are confident that we should be able to increase by a couple of basis points.
Yeah. So just to revise the numbers, 14.3% EBITDA margins for FY23 and FY24 will be 16%, correct?
Absolutely. The
Okay, got it.
14.3% is as it stands when you see the 3 quarters numbers and repeating the performance,
Sure.
the math works out. Yeah.
Okay. You know, I remember when we spoken to the company about a year and a half, 2 years back, you all had spoken about an ambitious target of $500 million in terms of a top line. Well, now at the current run rate, you're already above $200 million. When do you think you will be able to achieve this $500 million milestone?
We have kept ourselves, in the last year, we did a rejig on our strategy very clearly is that organically, we have kept a target by 2028, we should be getting to about 650 million. While inorganic is a pursuit which is considers several factors, but I think ambitiously the company with both put together organic and inorganic, we would like to see us at a $1 billion deal. $1 billion size basically, but organically I would put it very clearly that we are ambitious and we are having a plan till 2028 to be there at about 650 million.
By 2028.
Absolutely.
Okay, all right. So, considering whatever we've been seeing globally, I wanted your take on the retail segment that contributes around 16%. Is the cautiousness continuing here? What is the outlook going forward? And will this continue to remain that 16 to 17% mark?
We have estimated on a cautious basis 16-17%, but if you look at on the retail as a segment, basically, while the enhancements have not happened, basically, but we have not seen a pushback in terms of reduction in terms of the budget for the retail as a segment where we are operating with the customers. So we are, however, we have remained cautious for at least for the next 2 quarters. We remain cautious in terms of the retail segment.
Cautious, but what is exactly that you are seeing in the retail segment? Have deals been paused? Is the ramp up not taking place? Further spends being curtailed?
Yeah, the further spends are not being happening, and the ramp up in terms of anticipation is not happening, and has been deferred by about a couple of quarters.
Okay. All right. So then can you tell us what is the plan? Like, do you have any inorganic plans going forward in FY24? That is, because we are already towards the end of FY23. Something in the pipeline. What is the deal pipeline looking like?
There is a separate team which is reviewing that, and we are on an everyday basis. We are reviewing, and we are very serious on the inorganic side to acquire predominantly more in terms of capability on the digital engineering side for that. And we are evaluating proposals, but I think it's more fair basically that there is a fair amount of pipeline available today. And we will definitely come back shortly on that uniformly across as the board decides and then when we conclude. But then to answer in one line is that we are serious, we are on the job, and the pipeline is very good.
Thank you very much, Mr. Venkatachari, for joining us and laying out the shape of the demand for you. Get into a break. On the other side, we'll talk more about